What is going on, everyone? Welcome back to a new episode of the Daniel and Mark Show, brought to you by Hardcore Head Start. My name is Daniel. That is good old Marky. Mark, how are you, bud?
I'm doing well, mate. I'm doing well, but the market's not so much. I think it's been a really interesting week in the markets. I think I suppose for a long time you mentally prepare yourself for these dips that you're sort of hoping for, so you can sort of add to your positions and you kind of see them as opportunities to I suppose get like a lower average into the quality stocks that you have. But then I suppose everyone sort of processes the emotions even though they know better. And I suppose, like, to put things into perspective, from what I understand anyway, what we're down around like 8% from like all-time highs after like 117% move from the bottom. Like, I'm talking about the S&P 500.
Yeah.
So it's like we've done this much, we've gone up from here to here, and now we've just gone down a little bit, and everyone's like, "Oh fuck, it's all over. Pack it up. We're gonna have to apply for Macca's and get our jobs back." What are your thoughts on the market? I mean, look, cryptos are obviously a lot more. Crypto's taken a bigger hit, especially a lot of the altcoins. I've noticed, like, Solana's gone from like 270 down to around like $90 from the last I checked.
Yeah.
So definitely some bigger declines there. But what are your thoughts on what's playing out at the moment?
I mean, all similar to what it is you're saying now. It's from the only kind of difference in regards to, say, this pullback or correction or whatever terminology you want to use, is I don't have the cash flow anymore.
Yeah.
So it's considerably more difficult for me to actually, increase, I guess, or lower that average buy across the board, whatever it is that we're buying. So for me, it's been like, okay, now I'm just seeing everything that I have net worth-wise decrease by whatever it is that kind of the markets are moving. And so, you know what I mean? At the end of the day, so what?
Yeah.
I think people get, people just in general, right? Like, how many times do we see people overreact because of emotions and like the world is going to shit? And you know what? Maybe for a year, this is the reality. Maybe for 2 years, we're in a bear market. Maybe for 3 weeks, we keep doing this and then we revert and go back to what we were doing, attack all-time highs. What's going to happen? I have no idea. I have my sneaky little things I'm looking at, with market leaders, looking at all the indexes and stuff like that. And for me, over the next 6 months to a year, I'm not worried. I'm actually I think this is a good thing, because it gives the markets that rest that it probably needs. And it makes sense in regards to, like, what the Fed is doing. They're tapering and probably coming out with 3 interest rate hikes this year, more probably 2. So I think it all makes sense. In regards to crypto, people still want to ignore the fact that crypto is correlated to the rest of the markets.
Yeah.
If the S&P and Nasdaq have got drawing down, so is Bitcoin. It's just how it works at the moment.
It's I think I've got a pretty like similar take. Like, if you came into investing right at the start of your journey, accepting that it's going to be like a long horizon, right? Your time frame for your investments are 10 or 20 years, then like, what happens sort of over the short term, like 6 months to 1 year. I'd say, like, 1 to 3 years is kind of like the short term. 10 years is kind of like the minimum, like, for like the midterm, and then ideally you should be like thinking in like sort of decades, like 20 or 30 years for most of those investments. So I completely agree with you. Like, if anything, I think if there's a prolonged bear market, it's an opportunity to practice like meditating on the markets. It's kind of like process the emotions you're feeling, and then when you get on the other side of it, reflect on how you felt going through it and what actually played out, sort of after the fact.
Yeah, I reckon that's so important what you just said there, to actually like kind of like reflect on what's been going on. Because we can very easily, and it happens all the time. It can very easily revert back to all-time highs here, and then we can, get another 200% move across the next decade, and everyone will forget about this 10%. They'll forget about the emotion they were feeling. They'll continue to pack on the leverage. Like, the reason people are getting hurt at all is because they're just in risky positions in general.
Yeah.
Like,
Yeah, that's right. I think like if you're an investor, you're more or less like buying and adding to a position, and that's it, right? Or you're sitting on your hands. If you're in the latter group as a trader, then if you're feeling the pinch now, then you probably haven't taken enough profits on the way up. So, like when things are really sweet and you make like 50 or 100% in a year, if you haven't taken any off the table, then, obviously, as some of these stocks, retrace 20-30%, or in the case of like Peloton, you've seen the Peloton bikes,
Yeah.
pretty much gone from, pretty much like 85% drawdown, and a lot of these work from home stocks are getting hit hard.
Yeah.
So like, if you haven't taken profits on a short-term position and you're feeling the pinch now, that means you're overemphasizing the potential upside and you're undervaluing the potential downside, which means that, when it goes up, you think it's going to go up much higher than it can. When it goes down, you think it's only going down less than you think is possible, and it always goes deeper than you think possible.
Sure. Hardcore trading classes and, investing and all that kind of stuff as well. Like we have a hardcore coaching in regards to trading and character development, stuff like that. And that's one of the first things we teach is like, hey, instead of just thinking about the upside, it's more important to think about the downside. Exactly what it is you're saying. Like, that's a tried, true, and very important lesson for people to understand, because I mean, when everything's going up, it all looks great and everything's exciting and you're making money, so it's sexy, but it can very, very quickly turn around. And like, you can see a company like Netflix, which is a great company. You can be long that in the long term and shit like that. But if you're trading it and you were too aggressive and shit like that, things can happen that you won't see coming, like the 22% move down on Friday.
Yeah.
Right. And that's 100%. No one would have been expecting that. But if you're not thinking that can potentially happen, then you're not actually adding any, like, or you're not thinking if you're thinking there's no way that can happen, then you're going to add too much size or add too much leverage or allocate too much money to it. And then when something like that does happen, you're going to get yourself in a little bit of a pickle. And that's why people get scared, and then that's why liquidations start getting hit, and that's why the market goes down further and further and further, because it's just all that downward pressure and blah blah blah. But
yeah, so like take that like Netflix example, right? It goes down 22%. If the fundamentals haven't changed, then you should be holding that position, right? And if you find, like, I think it comes down to self-awareness. Like, if you're someone who's holding Netflix and you see that you experience that 20% drawdown, right? And your thesis was, I've got a contingency plan. I can see it potentially going down or correcting after a big run. But I'm holding this for a long time, so it doesn't matter. But then if you find yourself actually selling that position, right, as the market, corrects, then it's fine recognizing that and being like, okay, being self-aware, I need to work on my emotions, right? So then I need a bigger contingency plan than somebody who's like, I've seen this happen many times, I've experienced it, and I know I'll just hold and I'll actually do what I set out to do. Then you don't need to have as big of a contingency plan. So like, I guess not, like, simply put, if you're someone who knows that you're going to just buy and add and you'll never sell, even at like the biggest declines, and you've gone through and you've had those experiences before, and you've managed to hold through the tough times and see it through, then you could probably have like 0 to 10% cash allocation and just be completely in the market, because that's always going to generate the most returns on average, right? But if you're someone who like freaks out and you find that you're selling positions and then buying back higher, then you're probably somebody who needs to allocate 20 or 30% cash, because that just helps your psychology and it'll it'll help you focus on buying more rather than thinking about your only option, which is to sell because you don't have cash.
Yeah, for sure. I think for the most people, like the trading stuff we're talking about is like interesting. They'd be like, "What the fuck are they talking about?" I don't know what that means. But it's pretty interesting to maybe just realize, I guess, like the main point we're talking about is to always understand the downside and understand the risk in everything you're getting involved in. I think that's important across the board as well. Hey, Marky, not just trading and investing, just like think about the consequence of anything and everything you do.
Yeah. Well, yeah, I think a big part of like, experiences in real life and in the markets is sort of like experiencing both sides of the equation, so you understand what it means, right? Like in terms of like, if you're someone who always plays it safe, you invest, you kind of take more risk, and then you can kind of go, all right, oof, I actually made a lot of money. So there's benefits in taking risks, right? But also the other side is like, if you're someone who is always taking risks, eventually you're going to take this big loss, and that's going to make you appreciate safety. You get what I'm saying? So like, I feel like whether it's the markets, whether it's kind of like, in your personal life, like let's say if you're someone who's really conservative, you're in this job that you don't like, but you kind of stick it out anyway for many years, which I can, a lot of people can, probably relate to, or like you got responsibilities, you got like a house or whatever, and people depending on you, right? So the smart move is not to kind of take these big risks, but then at the same time, if you never take a risk, you never truly appreciate like the safety of that job. So like, I think, whether you're like a risk taker or someone who's more conservative, you need to sort of experience like both sides so you can understand and appreciate like, appreciate the other equation. It's like someone who parties really hard and goes on a binge. They're just like, they actually appreciate sleep and rest and alone time, like straight after it.
Yeah, it'll help you realize that sleep is important.
Yeah.
Is there times in kind of your trading or investing career that you can look back on and be like, wow, I was either not self-aware enough because I was trading against kind of my personality or anything like that? Any examples you can share?
Yeah, I'd say I lean towards taking too much risk, like when it comes to investments. So I know better, but the problem is when, I guess, like let's say right now, right, the markets are going down, and I understand the concept of buying when things are discounted, right? But I sort of go in too early, too hard, if that sort of makes sense. So then I end up in this situation where like I'm not quite overexposed buying the top, right? But I've also bought this huge position right in the middle of nowhere. like sort of, let's say like Solana, right, has gone up like from $10 to like $270. I kind of like sit on the sidelines for ages, and then like it drops down to like $200. And I'm like, oh, this is a good buy, right? But I buy this huge position, and then like it just keeps on dropping, and I just buy more to the point where I'm like, oh, like my whole portfolio is just like Solana. That's just an example. I haven't bought any Solana, just for the record, but just to prove kind of like my point, right? But my self-awareness and what I'm working on this year is buying, understanding position sizing, and also understanding what's the maximum size I want, in the worst case scenario. So actually thinking that one extra step. Okay, I want to buy when things are discounted, but what's the most I want to buy if this is the worst case scenario?
Yeah, I think that's really important. Like to think of the worst case scenario, similar to like look at Netflix right now. Still healthy if you look at the chart because it's pulled back to its kind of ascending triangle support, which it looks completely fine still if it heads down lower. I mean, it's just past the 200 as well, which people are not going to understand what I just said, but let's just say supports will hold the price up there. But who can predict a 22% downward move overnight? So if you have taken on too much size, you may have been stopped out even though it still looks healthy.
Yeah.
Right? I think that's kind of like your point there. It's like you can't stay in a position if you add too much size, even though
Yeah.
potentially it may be all right.
Yeah,
Again,
100%. I mean,
yeah,
like, let's take the crypto markets. Okay, so let's say you in May, June, July, right after that like 50% crash, you took a chance and you're like, look, I've been patient. I knew the market was too hot. Now I'm going to buy a huge position, right? And you managed to buy Ethereum around $2,000. It went up to 4,800, and if you didn't take any profits at all, right? Like, what do you think the psychology of someone is right now when the Ethereum sort of sitting at $2,300? You're
yeah,
kind of like, you're panicking. You're like, I have to sell, right? Whereas like if you took off, you've made 2.5 times your money, you took off half off the table, your psychology, like drastically changes. You kind of see like, oh, I can buy double the amount I sold and have almost 1.5 or 2 times the position I had. If you sold the entire position.
yeah, absolutely.
So
Maybe changing it slightly. Obviously, hardcore. We have a long-term
yeah,
portfolio, right? So we
yeah,
have clients that we need to, deal, help and deal on a regular basis and kind of answer their questions, anything that we can. And I think like the questions
yeah,
we got recently are like, what's going on? Is this normal? Should I try and, I guess, optimize the buying I'm doing? Should I, instead of buying now because it's dropped down 9%, should I wait when it drops down 20%? Things like that.
mm.
Um, and one
They're
pat on
good
the back.
questions as well.
Yeah, great questions. One pat on the back for us, I would say, as a company as hardcore, is our portfolio, as in copiers, is growing even though the market is pulling back. Or if it's the copiers are staying the same. And why that's really important is because what we pride ourselves on adding as much value to our clients and adding as much value to, I guess, anyone we talk to and the people around us through these podcasts and stuff like that. So when you can see
Yeah,
a market pull back by 20% and people asking questions of like, should I optimize my buying by buying lower and stuff like that? It means when we're consulting with these guys, we're giving them the confidence in, us and in the markets that they want to continue and buy more. They realize that these everything's in red. Looking at those red, that means discounted prices to them. And when investors
yeah,
are new, more often than not, it's more of a fear response when they see red in the market.
yeah,
So I guess and everyone in a majority of people in that portfolio, this is sometimes their first investment vehicle, their first time dealing with the markets. So to have kind of, or like I'd say a very large portion of them saying, hey, this is the time to buy more, right? And stuff like that. And I'm very, very confident that that is the right message to continue to pushing to people. And it's just really good to see that everyone in the portfolio is thinking similar to that. So I was curious if you have anyone kind of in, I guess, your life at the moment who's thinking similar to that, or this is their first time investing
yeah,
and they're a little bit worried, and what kind of
yeah.
questions have you been getting as well?
Yeah, for sure. So like, people closest to me, right? Like, my girlfriend, her younger brother, and other people, right? And kind of like my thoughts on it, right, is to kind of look at the data, and from the data, kind of make like averages of what tends to happen, but then also, sort of think about outcomes that are possible too. So, like if you sort of play out the 5 possibilities of how the market can play out, right? It doesn't mean that each of those 5 probabilities are going to have equal percentages of playing out,
Sure.
right? Like the market dropping, let's say, we had like roughly like 30% drop, like March 2020, right? Like coronavirus,
Yeah.
that the first initial crash. The chances of us having a deeper decline that happens sort of over like 5 years, it's a possibility, right? You go back to 2000, but how often do we see a 30% correction or crash followed by another 30-40% crash like within like a year, right? So I kind of think about those things. So there's definitely a possibility it can play out, right? Maybe the whole growth sector is kind of overvalued, and like we have a prolonged bear market, something we haven't seen in like a decade or 2 decades, right? But the probability of that, I would put sort of percentages. I'd be like, all right, that's a possibility, but I think that's probably closer to like a 3 to 5%. And then like I look at other corrections, right? And on average, I find that sort of sits somewhere between like 8 and 20%, which gives an average of 13% corrections every time there's kind of like a fairly big sort of movement up, like past all-time highs. So then I think to myself, okay, where are we at relative to that, right? So I know that we're down about 8%, and I know 13% is average. So I know there's a good chance that we could either head up from here, or we could go down to 20%, a deeper decline, and then head up, or go to the exact average of 13% and head up. So those are all possibilities. But I kind of play in my head. I go, all right, 13% is probably one of the higher probability plays, right? And I'd say there's probably almost equal but slightly less chance where we just head up from here, from like 8 to 10%. So it's kind of like figure out the potential outcomes and then give them sort of weightings of like just roughly, so that you've got like your own contingency plan or like mental models of like what's gonna happen.
Absolutely. Yeah, no, fuck, I can't add anything to that. You said it well. I mean, people just need to assess all of the potential possibilities, right?
Yeah. And you know what, like that mentally prepares you. If you have in your mind, like, okay, the stock markets could go down 40% and it could do this over like 2 or 3 years.
Yeah.
Then is it going to suck? Like, fuck yeah, dude. Like, you're going to probably like stress the fuck out, but you're going to be okay because it was a possibility that you'd considered.
Yeah. You don't want anything to be a surprise, right? Because that's where the emotion will come from. When you're not expecting it, then it's going to be like, what the?
What's happening? Yeah.
What's happening? And for the best in the world, like that's, they don't ever want to be surprised by something that happens.
Yeah.
I was looking at, like, obviously we don't hold a hell of a lot of weight to like PE ratios and that kind of shit, but a lot of the investing world does, I guess. What do you think at this current time is a PE ratio of Amazon? You had to guess.
Like what it is at the moment?
Yeah. Like knowing it's a technology company, and there's so like that's actually an unfair question. How the fuck would you possibly know? But
I don't know. I'd say like 58.
Joking? It's 59. That's mad.
Is it really?
Yeah. So,
I feel like dude, that was it was the biggest guess, but also at the same time, I feel like because I've watched Dylan's market updates, I feel like I know it's in the ballpark of like 30 to 100. So like I just kind of went bang in the middle. But that's, dude, why not? That's pretty good.
That's so fucking ridiculous.
Is that like right now, like after the correction?
That's what I'm looking at right now.
No way.
Yeah.
Okay.
So, but the point is, like, people hold a certain amount of weight to the PE ratios and all that kind of crap. And essentially, for the longest time, tech companies have like been so overvalued with PE ratios in the hundreds and thousands and shit like that. And if you're looking at it from this point of view, man, this is like a really, really, like, they're pretty cheap. Like Apple's 29, Microsoft's fucking 33. Berkshire Hathaway is 8. Like these companies, like, I don't know if that seems like companies that are way overvalued and haven't already had some form of pullback and correction. That's a good sign to me.
You know what? Like, outside of stocks, most people are kind of used to, you do something bad, you see the consequences immediately, right? Whereas like the stock market is very, I think like Dylan sort of put this pretty well. Like you're kind of looking six months at least into the future, or like 12 months, right? And like if you go off that basis and you think to yourself, all right, the 3 or 4 interest rates that they're predicting, right? Could that potentially be priced in at this point? So like potential, I would say there's probably like a 60 to 70% chance there's going to be at least 2 interest rates, right? But if you ask me if they're going to actually do all 4 interest rates, I'd say it's probably like a 40% chance.
Yeah.
And based on that, I think a lot of people would, like, I don't know if I'm off the mark, but I think that's probably like the average, right? And based on that, I think like 2 interest rates are probably like priced in now. And, like let's say if there is another, like a third interest rate that's hiked, like that comes in sort of like September, that's where we might see another sort of decline because people are like, oh, okay, this is actually playing out.
Yeah.
But I think for the most part, I don't think we're going to like see a 10% crash, before the first interest rate and then another 10% before the second and then the third and the fourth. It's unlikely to play out like that.
It doesn't make sense. Like
I
remember, do you remember the feelings? Were you watching the Fed release of kind of like, the potential increase in tapering or speeding up their tapering and, how many rate hikes and shit like they're going to be? The hype around that day was crazy. All right. Everyone in like the, normal kind of world like CNBC and all that kind of stuff like this, it's the biggest deal of all time. And it is a pretty big deal, I guess, in regards to like what's going on in the financial world. But it's no longer like people had already assumed they were going to do this, and this. So when Jerome Powell came out and said, hey, we're going to do this, and this, exactly the same what people were thinking, it wasn't a surprise to people. People already had those assumptions. So the market didn't react in a very bad way. It reacted as you thought. Yeah. But I guess like another question is like, well, what if it came out as a surprise? What if he did say, no, we're like speeding up tapering, we're going to be done in a month and we're going to be definitely doing 3 rate hikes? Then that's surprising to people. So it's going to be like, okay, then I'm, emotion kicks in for people and they get scared and fear sets in and then it just continues to topple over on each other throughout the year and shit like that. But yeah, I think it's actually a really good conversation. People realize is like emotion actually drives the market more than anything. And when people are surprised and don't know what's going to happen in the future or what's going on now, then they get scared.
Yeah. I think probably like adding to that, if you feel like you're not like that in tune with your emotions, right? Or you feel like you don't have an accurate sort of reflection on like how you felt like during a certain time, like journal it. Yeah. And I think like, sort of on days where you're finding like, oh, like I'm actually paying attention to this drop in my portfolio, oh, this number feels big to me, right? Journal down and write down that date and write down like on a scale of like, 1 to shitting my pants and like, fucking flipping everything upside down. Like how scared am I? What are my emotions? And what's the data? What's actually happened? And then just keep recording that. And if you see like a pattern, like I always like shit my pants just before like the market turns around. And like that happens like, 4 out of 5 times. And you probably need to kind of go, all right, I'm experiencing the same feeling. I'm recognizing it. And I know I'm going to do something different this time.
Yeah, absolutely. Well said, my friend. Well said. I think for people kind of like new investors, what can they take away from like today's conversation is just, I mean, we spoke about some pretty complex things, which are going to be hard, but the main point is like, if the stock market goes to zero, the world pretty much ends, right? So the fear is not justified.
Yeah.
What do we say all the time? We say it on so many hardcore podcasts and especially within hardcore as well, is like, just dollar cost average the world. Keep buying. If you've got the ability to have cash flow coming in regularly, continue to buy because you're getting these discount prices. And when we go back up, and we will go back up, whenever that is, you'll be in a considerably better position.
Yeah.
So
100%. And I suppose like really if you're a fairly new investor, you should only be thinking about 2 things, right? Like you're either buying and adding to the position, or if you're actually genuinely worried, then you should reevaluate how much money you're investing. Yeah. So like, if you're thinking, I've got these plans and I was counting on my investments going up in the next, couple of years in the short term, then you probably haven't planned for that thing, properly. You probably need to be organized and be like, okay, what are some of the short-term things that I need finances for that, I can sort of plan out without actually having to look at my portfolio or my investments as a way to make that happen.
Yeah, absolutely. If you're a long-term investor, you shouldn't be looking to reap any of the rewards until the long term.
Yeah.
Simple,
Yeah.
right? Don't make plans on that capital unless you're planning of using it for something that's going to help you make more capital.
Yeah, I kind of see it like as like a checkpoint, right? Like your superannuation gets paid out at like 70 or 65 or whatever, and then like your stocks is like at 40, 45. It's like a pit stop.
Yeah. Well, yeah. I mean, depending on what you want, for sure. Can.
Yeah.
Absolutely. All right. Shall we wrap her
Yeah.
up?
Pack her up, man.
All right, everyone.
Thanks.
Go. You go.
I was just going to say thanks for joining us. If you've made it this far, congratulations. You've got better attention span than most of us, me and Daniel included.
Absolutely. As always, please like, share, subscribe, click the notification bell to know that when we are posting. We usually come out in the earlier parts of the week, so between Sunday to Tuesday. So
yeah,
make sure that you're watching every single damn episode because it's a hell of a lot of fun. Marky and I enjoy them, and enjoy the rest of your week.
Yeah, just one last thing. If you're listening and you have any feedback for the podcast, so like if the concepts are kind of really over your head, or you want us to kind of simplify or sort of focus on some of the concepts, or you kind of want us to go even deeper in the sort of like the technical side, let us know, because it'll kind of drive like where we take the conversation.
Absolutely. Perfect. Thank you all. See you, Mikey. Fuck, I can't see.